Let's continue on to wrap the week. I did want to start with a poll, and one of the polls we asked you recently was focusing on sector rotation, leading into the theme of the day here. What sector performs best between now and year-end 2020? I gave you four choices: energy, financials, technology, consumer discretionary. Votes are in, and basically it was kind of split between energy and technology. Technology sort of edged it out by a couple percent, but those two were by far the strongest responses. We also had about 15% or so for financials, just under 20% voting consumer discretionary. So overall, technology and energy sort of 1 and 2, which is interesting. Those are two actually very different spaces with very different return profiles, and interesting to see that we're sort of split between those two. Of course, those could certainly be the two that perform very, very well. And again, it's all about what ends up being that sort of safe haven offensive type of thing that's going to help propel us into the end of the year. I did not vote in this survey. Boy, if you asked me, I would probably say technology. And I'm just thinking of the defensive nature of semiconductors. I mean, if I had to pick a group, it would probably be semiconductors in terms of things that it's probably going to hold up well. It's done okay, and then some of the names have pulled back a bit. That's not a bad place. I did not give you the option of communication services, but that would probably be my top vote if given the choice. There you go. Great. Thanks as always for answering those questions. We have that running at all time on stockcharts.com/TV. Let's continue on with our wrap the week segment. We're going to go into the weekly chart here. Here we go. This is looking at the last 5 trading days. We're starting the clock on Friday's close. I don't have the labels on here, so sorry for that. I'll sort of talk through the returns here as we update it for the closing prices. The S&P 500 is here in black, down 1% for the week. And if you look, it was sort of a choppy downward motion for much of the week. Most of that came on Thursday, the distribution pattern that you saw off of Wednesday. So overall there, what underperformed the S&P? Only two things: the NASDAQ 100 down 1.2%, and down here at the bottom, Bitcoin down 3.4%. Now, last week, as I told you, Bitcoin is usually at the very top or the very bottom. And last week, if I remember right, it was up here in the double digits, and everything else was down middle of the road. So Bitcoin certainly just come off a fairly accelerated level, coming off that high just below 20,000, now pulling back a bit. And I think for a lot of crypto bulls, the question is: are we reloading? Are we reloading? The powder to propel above 20,000 and never look back. We'll have to see what happens next week and beyond. What outperformed the S&P? Emerging markets only down about 0.25%. Here was gold up 0.1%. The dollar up 0.3%. Gold and the dollar certainly have more been in downtrends and have been giving back a lot of their previous gains. The dollar certainly weaker, and it's propelling U.S. underperformance versus global stocks, as we hopefully will get to in a little bit. In terms of things that really outperformed a little more meaningfully, small caps up 1.1%. In brown, we have crude oil up 1.2%. And in red at the very top, bonds up 2.3%. We've talked about the bearish scenario for bonds, which is sort of the base case that I'm looking at. You certainly didn't see that this week, where the stock to bond ratio, and according to the week, certainly favoring bonds over stocks, although the long-term trajectory certainly has been favoring the S&P over the TLT, if you look at the two of those. Let's just review very quickly what else happened today, and then we'll get into the Mindful Investor Live chart list, which is where I'd like to spend as much time as possible. The Dow was actually up a token amount today, the S&P down a little bit. It was really a V-shaped move with the sell-off into lunchtime and then a rally going into the close. Small caps down 0.8%, so that was probably the big loser out of the major indexes. The VIX back up around 2340 or so. Bonds, finishing the day a little more positive than negative, up 0.4%. 10-year yields back below 90 basis points. Gold and silver essentially mixed. Gold rallied pretty good out of the open, but settled back down. So overall, sort of a mixed bag there in the commodity space. Oil down a bit, and that's why energy was the worst of the 11 S&P sectors. In terms of sector returns, you had communication services, consumer staples, industrials, all up. And again, if you ask me to look at one sector, tell you one sector based on the individual stocks that I've been looking at that tend to have some of the more attractive charts, I would probably go with communication services, and it's a lot of different patterns, and it's if you go outside of the mega cap stocks, it's outside of the things like Alphabet and Netflix and others. You go into things more like the video game names, the media stocks. Disney obviously up pretty significantly today. if you missed that. So stocks like that are in beautiful setups. And I think, from a bottom up perspective, pretty strong sector. What underperformed today was energy, was financials, materials, consumer discretionary. And energy and financials, those are two sectors, especially on the RRG, you can see them moving almost in lockstep in some ways, sort of rotating around the benchmark. That's something to pay attention to going into next week. In terms of individual names, just want to point out, boy, cruise lines, airlines, they tend to be the biggest gainers or the biggest losers, and it's back to the biggest drops in their scooter rankings. Now, something like AAL, this individual chart is just fascinating. It's this cluster of big up and down days. You had, a down day on Wednesday, and updates actually called, you may kind of call that a bullish piercing line, but I don't think I would necessarily be as big a fan of that. You really want to see that more in a downtrend, but finished up and then gave it right back today. This is what you call a bearish harami pattern, where the second day's range is engulfed by the first day's range, but it's a down day after an up day. That's short-term week going into next week, according to the candle patterns. That stock down over 5% today. Plenty of individual stocks to look at. We'll get into some of those on Monday's show, but let's continue on our weekly wrap by focusing on the Mindful Investor Live chart list. This is designed to tell us overall long-term structurally what's changing week to week. In terms of what's not changing, it's the overall structural uptrend in U.S. equities. The S&P on our market trend model remains bullish in the long-term, medium-term, short-term measurements. These are all based on weekly exponential moving averages, as we've discussed before. The long-term model bullish since June, medium-term model bullish since early November, and the short-term model bullish since early October, late October, excuse me. So overall, all three of those saying long and strong, and that's right. When the market's at or near new highs, making a new intraday high or intra-week high this week, certainly would expect those to be positive, and that's what we're seeing. Looking for downturns in the short term or medium term would be one indication that the uptrend is exhausted, and that not just that it's exhausted, but that sellers are actually taking action. Profit taking is occurring. We haven't seen it yet enough to trigger that model. The daily chart of the S&P, I bring this up just to show, Wednesday we had this bearish engulfing pattern. This is why engulfing patterns are something I don't talk about a lot of candle patterns, because in general, it tends to be a shorter term methodology. If I was a swing trader, I would be spending a lot more time thinking about them and trading them. And there's a whole discipline of looking at the levels and the highs and lows of the patterns. And if that's your time frame, I'd encourage you to dig into Steve Nissen and others who have done a great job sort of articulating how to use some of those different candle patterns. But this bearish engulfing pattern is something I do use because it tends to have a broader impact. Seeing that suggests a transition from short-term bearishness to short-term bullishness to a short-term bearish read, and usually it tells you about the next day or two being weaker rather than stronger. And that's what we've seen. We've seen the S&P pull back a little bit. This doesn't count nearly enough to call this a broad pullback or a pullback enough to register on the daily chart. Daily chart still appears to be in a pretty good uptrend. As we would continue down into next week, if that's what happens, 3550 to 3600, this green shaded area was absolutely the first line in the sand I would be eyeing. As long as we remain above 3550, that's a pretty strong uptrend still in place. A break below there, break below the 50-day would cause me to rethink that, maybe look at some of these lower pullback levels. But overall, until proven otherwise, trend is positive. And I think one of the ways you can see that is with the breadth picture. If you look at large cap, mid cap, small cap, the broad NYSE, all of those cumulative advanced decline lines going to new highs, higher highs, higher lows. That's an uptrend, and it tells you that essentially there's broad participation. This is not a small limited number of stocks that are pushing to new highs. It's a broad advance driven by a number of charts. A lot of charts look fairly constructive here. In terms of new highs and new lows, non-existent new lows, because very few stocks are anywhere near their 52-week low. That makes sense. But the question is, do we see a continued amount of 52-week new highs? You saw a little, very few number yesterday after the pullback off of the intraday high on Wednesday. This is not updated yet for today. I would assume you'd see a similar sort of reading to that. So, going into next week and beyond, you want to continue to see a healthy number of stocks making new highs. That tells you even if the S&P is not able to power through 3,700 and go beyond, individual stocks, certain groups, certain themes are still working. So that's one thing I would certainly want to see if I'm bullish and expecting upside going into the beginning of the next year. In terms of breadth here, we're looking at the percent of stocks above the 200-day moving average. We're just above 90% as of Thursday's close. We peaked out around 92%. You can see from this blue horizontal line, we haven't seen that in over 5 years. You have to go back to things like 2009, a couple times after that, maybe 2013. I think you saw a similar reading. And while you're right, both of those, the market ended up higher a year later. Most of the times when that's happened, you've had at least a bit of a pullback because so many stocks above their 200-day means sort of everything's working. And when everything's working, certain things start to not work just a little bit, and the market corrects a little bit. So that's one of these sort of tap the brakes type of things that I'm seeing. Sentiment has been fairly elevated. I've asked Mark Young about this, who's one of our sentiment experts. He was on the show yesterday, did a great job talking about some news, some other sentiment surveys that we don't refer to very often on the show. But I did ask him about the AAII survey before the show. We didn't get to it, I think, during the main interview. But, his comment was, you have to remember that, is it elevated? Absolutely. For him, the extremes on the upside are less meaningful than the extremes on the downside, was how he described it. So he said the fact that, so many people are bullish are less of a concern. It's less of a timing tool. That didn't help me feel any better about the fact that almost 50% of respondents are bullish. And when I look back, I'm finding a lot of times where that's closer to the end of the uptrend as opposed to the beginning of the uptrend. But for what it's worth, that was his take on it. So, what concerns me more than that are things like the put call ratio at all-time lows. I mean, literally all-time lows. RIDEX flows at all-time lows as well, both sort of contrarian bearish signals. In terms of ratios, I'll just hop around very quickly here. Semiconductors continue to do very well on a relative basis, pull back a little bit going into the end of the week, but you can see the long-term trend certainly remains very, very positive. That's been a good group in an up tape and also in a down tape, and I think that's an important one to continue to watch. Small caps continue to outperform. Look at the relative performance of small caps since late September. It's been just accelerating to the upside, which was pretty impressive. The last thing I just wanted to highlight, we talked about the weaker dollar and some of the concerns there. If you've not looked at this chart in a while, this is the ratio of the SPY versus ACWI, which is All Country World Index, which means it's sort of like the US versus the entire global equity markets. You can see that this has been favoring non-US stocks since mid-October. So if you've not been planning on a weaker dollar, if you've not been looking at your non-US allocation, I think this chart hopefully would encourage you to revisit that and look for some opportunities outside the US. At the very least, some sort of exposure there could certainly be helpful if this line continues lower, we get a weaker dollar going into next year. That is our weekly wrap. A lot of themes to touch on, and overall, again, a market that has been healthy, and it's all about identifying when a trend is exhausted. Let's take a break. We'll be back with the final bar mailbag. We'll see you in a minute.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.